The stock market has been falling fast the last several days because of comments made by Jerome Powell at the Federal Reserve's annual symposium at Jackson Hole. The Nasdaq and S&P 500 are both down over 5% over the last 4 trading days since Jerome Powell's speech at the conference. To get a better idea of what the market has been reacting so strongly to, let's take a closer look at Powell's speech and what was said. Jerome Powell frankly came out guns blazing with one message that he wanted to deliver. The Federal Reserve will do what it takes to fight inflation and will not be changing course anytime soon on its policy. He set the tone when he said at the very start of his speech that it would be shorter, narrowly focused, and much more direct than his past speeches at Jackson Hole conferences. He then proceeded to tell observers that the FOMC's focus right now is bringing inflation down to the 2% goal the Fed has. For context, the CPI inflation data for July was 8.5%, which is far from the Federal Reserve's stated target of 2% inflation. He then talked about how price stability is the bedrock of the economy, and it's the responsibility of the Federal Reserve to maintain it. Jerome Powell then said, quote, "Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain." End quote. Jerome Powell then discussed how the Fed has shifted its policy stance to be more restrictive, and discussed how they had been raising the federal funds rate to bring interest rates in the economy up and slow down demand. Jerome Powell cautioned that, quote, "Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy." End quote. The stock market reacted very negatively to Jerome Powell's messaging that interest rates would need to be higher for longer, as well as him saying in his speech that the labor market would likely soften and that there would also be some pain for households and businesses. Up until this speech at Jackson Hole, stock market optimists had been speculating that the Federal Reserve may pivot and become more dovish as the economy and inflation starts to slow. Jerome Powell's speech explicitly said that the Federal Reserve would not be changing course anytime soon and could not afford to prematurely lower interest rates, which invalidated the idea that the Fed would be pivoting anytime soon. The stock market rally that had been taking place since July on these hopes quickly changed course when the tough messaging from the Federal Reserve came out. Something else that was very notable in Jerome Powell's speech is how he pointed to Paul Volcker, the former chair of the Federal Reserve during the 1980s, and how Volcker handled beating the high inflation of the 1970s. In order to combat the high inflation of the 70s, Paul Volcker had took the federal funds rate all the way up to over 19% in the early 80s in order to end the high inflation that was plaguing the economy. These high interest rates contributed to 2 recession periods in the early 80s, as the economy contracted due to high interest rates. But it was ultimately what was needed to restore price stability to the economy. What made the inflation of the 70s so difficult to correct was the fact that inflation had gone unchecked for so long, and the Federal Reserve before Paul Volcker had wavered in their restrictive policy. Jerome Powell is specifically looking to this earlier lesson of fighting inflation for guidance, as he said in his speech, quote, "The successful Volcker disinflation in the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem the high inflation and start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now." End quote. This commitment to higher interest rates alarmed the stock market because it's now very clear that interest rates will be higher for the foreseeable future, which will place downward pressure on stocks and the economy. Interest rates have a huge impact on stock valuations. As interest rates rise and more money can be made by loaning out money and collecting higher interest payments, this creates more competition for stocks, since there are more ways to get a return on investment than simply investing in equities. When it's not possible to make much money on loans via interest, this forces most money into stocks and other equities, since money looking to make a return simply doesn't have any other options. But with interest rates rising quickly now, there is an alternative, and it's putting downwards pressure on stocks. This is especially true of stocks and companies that aren't currently profitable, or expect most of their profits to come from future growth. Now that money loaned can start collecting higher interest immediately instead of minimal interest payments, it changes the calculation that people are willing to pay for future growth. After all, why invest your money in a company that might take years to start generating profits when you can start getting a return immediately by loaning out your money instead? This leads to investors discounting future cash flows in stocks that are currently not profitable or expect most of their profits to come from growth. With the Federal Reserve signaling that they will continue to raise interest rates to fight inflation, this higher rate environment will continue to put downwards pressure on stocks, on both the valuation front as well as slowing down spending in the economy, which could put downwards pressure on stocks through decreased earnings as well. Because of this negative impact that high interest rates have on stocks, market prices are reacting negatively to Jerome Powell's comments about the Fed's intended path forward. And this is what sparked the over 5% decline in the S&P 500 and Nasdaq the past few days. With high rates being around for the foreseeable future, this will continue to weigh on stocks and any rallies that the market has. But be sure to let me know your thoughts on Jerome Powell's speech and the Fed's commentary in the comments section below. If this video was helpful, be sure to subscribe to the channel for more investing and finance content, and leave a like on the video. Thanks.